Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Tuesday, the 6th of August, 2024. So before we start our Daily Dose of Market Insights for today, let's take a look at the disclaimer side first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook for today on the various major cross-asset classes, ranging from the major US dollar pair, the major stock indices, to key commodities market, which is gold, XAU/USD, and West Texas crude oil, pardon me. Let's have a recap what has taken shape yesterday, and as well as the current fundamental and intermarket dynamics that is at play that could impact the cross-asset classes from a longer term and a medium term perspective. So we know that yesterday, for those who are follow our daily dose of market insights since last week, we do mention about that ongoing across the board risk off scenario that has taken shape in the market due to two things. One, we have over concentrated optimism in the mega cap technology stocks, which are heavily weighted in the Nasdaq 100 and the S&P 500. So that actually kickstart that potential, we call it a risk off event, and also being reinforced by the potential heightened fears of a hard landing or recession scenario that has already been in motion in the US economy. That means, i.e., the Fed is late in the game of cutting interest rates. And what we could see over here is that market has started to price in deeper rate cuts by the Fed to actually combat this potential recessionary scenario that's already in place in US, and that increased bets in the magnitude of the rate cuts, which I highlighted yesterday, where market has started to price in now 50 basis point cut in the September FOMC meeting, and another 50 basis point cut right after the US presidential election. So that's in the November FOMC meeting. Prior to that, about 1.5 weeks ago, market is still looking at only a 25 basis point cut each in these two meetings. So, but however, the fear of this recession begin creep into the market. That means market starts to price in more interest rate cut is actually not good for the financial market. Yeah, it's good for the economy, but not good for the financial market because it creates this kind of indiscriminated selling across the board, and also could potentially be reinforced by quantitative we call it funds that tend to actually use their algo to trigger such we call it condition. Once a condition that's being made, and it cascade down across the board. So what we could see yesterday over here is that in the US stock market, let me share with you on what happened in the US stock market. So in the US market, what you could see over here, this is the heat map of the S&P 500 entirely in the red. So a lot of indiscriminated selling taking shape. So it seems to us that the market is reacting that the global economy is facing some kind of synchronized systematic shock. That means, i.e., a potential, we call it a key high concentrated risk financial institution is about to collapse. Something along this narrative that the market seems to be actually looking at. That means something like a Lehman Brothers crisis, or potentially something like a mini US regional banking crisis that could spread into the US economy and thus spreading to the rest of the world. So that's what happened in Silicon Valley Bank last year. But however, if you look at the past few months or weeks, there is no, we call it news or data or any signs that there's this potential systematic risk, we call it a driven meltdown caused by any failure of any systematic banks in the world at this moment in time. We do not hear anything news out from that. So the only way I can think of yesterday's indiscriminated selling start where we actually saw the Nikkei 225 that panic selling. So later I'll share with you, because the Nikkei 225 fall to a key support level, and it's yesterday is more like a panic mode instead. So it seems to us that, in my opinion, it seems to be that yesterday's slew of synchronized risk off episode or risk off activities seems to be triggered by some quantitative, we call it a fund that got blew up in some of their strategy. And because quantitative fund, they do not have any human intervention. Once a particular condition is being triggered, it could actually cascade down the road, and it could actually lead to this kind of cascading effect, either on the negative side or on the positive side. So unfortunately, yesterday we see a negative cascading effect over here. All right, but what's interesting over here is that this negative cascading effect seems to form a panic, we call it condition yesterday in the US stock market. And later I'll share with you some of the intermarket dynamics is actually showing a bullish key reversal potentially that could form yesterday. That means, i.e., yesterday could be the climate selling for that risk-off event that has taken shape since in the last 3 to 4 weeks, and potentially now the markets is actually due to actually come down to subside, and we start to see a more of a mean reversion risk on behavior coming back into the global markets again, at least from a short-term perspective. So later I'll touch more about that when I cover the fundamentals and the intermarket dynamics. So let me share with you the intraday movement of the S&P 500 and the Dow Jones Industrial Average, and as well as the Russell 2000. So look at the S&P 500 over here. Initially, it gapped down at the start of the session. I think close about -5% or 4%. Then thereafter, it tried to trade upward and ended almost close to the high of the day. All right, close to the high of the day. So let I'll share. If you look at the we call it the candlestick of the S&P 500, okay, you realize that over here it gapped down and it closed in the middle point of the range yesterday, not the higher, but formed this kind of what I call inverted bullish reversal candlestick formation on the daily chart over here. And what's interesting over here is that the movement of the Nasdaq 100 also pretty similar as well. All right, it gapped down and it tried to actually trade higher throughout the day, but at the end of the day, because of the huge gap down, it still ended in the red of -3%, both on the S&P 500 and the Nasdaq 100. And what we see over here is that the Dow Jones as well, okay, very similar, but the Dow Jones a bit lackluster. It closed near the low for the day. But what's important over here is that we need to find out the culprit that trigger this synchronized global risk off at the start is actually the Nasdaq 100. Then thereafter, on the Asia side, we follow the Nikkei 225. So let's touch more on the Nikkei 225 yesterday, where it's yesterday fall, it actually have a dramatic fall of negative, I think 12%, intraday fall -12%, and that was the steepest fall so far in the second steepest fall then since the 1987 Black Monday morning in October 1987. That all right. So now, given that the Nasdaq 100 is one of the first, is the kind of the trigger, the first trigger point that trigger this global risk-off scenario, any positive element that come out on the Nasdaq 100 will be deemed as a positive for the global financial market, because this guy is the one that is in the first block of the domino, that one this domino got triggered off, and it lead to this cascading impact throughout the rest of the world. Okay, so the first thing to do over here is that to monitor this Nasdaq 100 movement. Any positive movement over here could lead to at least a short-term mean reversion or mean reversion risk-on scenario that could actually take place in the market. That means yesterday is a climatic sell-off and a potential key reversal day. All right, so now, this is what happened at taken shape in the market yesterday. Then, from a fundamental perspective right now is that yesterday we do have a key US data that came out on 10 a.m. Singapore time, 10 p.m. Singapore time, pardon me, right? So this particular data that came out over here is the ISM Services PMI. So once this data came out over here, the market continues to sell off thereafter. So I would say that it's a bit indiscrimination sell off. Why? Because this data is not very bad. In fact, it's bad. It's good. It's a good data indicating that the US economy hasn't it kind of reduced the probability of this hard landing recessionary risk in the US economy that the market participant has started to assign a high probability last week, because ISM manufacturing PMI data was very bad in contraction territory. ISM manufacturing unemployment subcomponent of the PMI also show hiring start to slow down. And on last Friday, we have the non-farm payroll also very lackluster, with the unemployment number ticking up to 4.3%. Then, like I said earlier, the ISM manufacturing PMI data market pay attention to it, but in terms of the fundamental aspect, it's not so much significant in the US economy. Why? Because the manufacturing sector doesn't contribute so much growth to the US economy as per se, because US is no longer a global manufacturing powerhouse since 10 to 20 years ago, but instead they rely more on their services activity or the services sector to actually pump up or to sustain their economy. So the services sector comprises, together with consumer spending, close to actually contribute to about two-thirds of the US economic growth on an annualized basis in the last 10 or 20 years or so. So that's why ISM services PMI data, in my opinion, has a much more important say than the manufacturing PMI data. But you know that financial markets are sometimes they are irrational in nature. Any data that is good or bad, whether is it fundamentally sound or not, market will react to that accordingly. So that's why we also need to pay very close attention to the technicals as well. So that's why in my daily dose, I cover both the fundamental, the technical, and the intermarket dynamics to give us a better comprehensive and a view of the market. So if you look at the ISM services PMI, in fact, they expanded and rose above 48.8 from June, that was printed in June, to 51.4, slightly above market expectation. So which is actually positive for the US economy. So kind of reducing the probability of a hard landing or a recessionary scenario that was being priced on the higher side last week. Notice there's an uptick over here. So you look at the 5-year trend, it seems to us is sideways. It's not like plumbing downwards, all right, like the manufacturing PMI. And one more important, if you look at the services employment data, which is the subcomponent of the services PMI. So this services employment data is not real hiring or hiring, it's actually survey-based hiring. That means the ISM Institute who compile this PMI data send out a slew of survey form to the various purchasers manager of the various services sector-based company in the services industry in US, and from there they could actually plot whether are there more intention of hiring or intention of freeze the hiring process in this services industry in the US. So based on this services employment subcomponent, it actually flew above 51.1 level. That means above the expansionary mark of 50, and also way above 46.1 in June, and also way above market expecting of 46.5. So what it means that over here is that the managers that are in charge of hiring in the services industry in US, as being compiled by the ISM Institute, is indicating to us that they do not have the intention. Okay, where was it? Yeah, they do not have the intention of having a hiring freeze or a retrenchment program taking shape based on survey data, like I mentioned again, because all these are not actual hiring, it's actually survey based. All right. So if you look at the trend of these services and employment, is in fact starts to tick up from last 3 months of very low downtick over here. Could this be a potential outlier? Well, we got to see the next, we call it month data to confirm a trend. All right, so if the next month data in for the month of August starts to tick up higher again, that means it's also telling us that number one, the the probability that was being assigned to a hard landing scenario in the US economy last week is a bit overstretched on the upside, and things could get normalized again. So that also potentially, right, these two data over here also potentially supports that yesterday's move in the global stock market or in the global financial market of this synchronized risk off activity or behavior is very, very much overstretched, indiscriminate form of selling, which could actually see yesterday was the climatic selling level, and potentially we could start to see a key reversal points that's being formed on the markets, where potentially we could start to form this at least for some form of short-term mean reversion rebound or mean reversion risk on behavior starts to creep back into the market again. All right, so these are the key, we call it data that took shape yesterday and its impact on the market. And what we could see over here is that the impact has really started to feel in the FX market right now. So if you look at the FX market, this is the 5-day rolling performance. So previously we know that the risk off a synchronized risk off, not risk on, a risk off activity that took shape 2 or 3 days ago, and yesterday was the most dramatic one. We start to see the dollar weakening against the Japanese yen and the Swiss franc, because these two are traditional safe haven currency, where then after that we see a K-shaped reversal where the dollar strengthening against the Aussie, the CAD, and the Kiwi as per se. Why? Because the Aussie, the CAD, and the Kiwi are commodities related currency, and they are related more on the demand side of the story. The Aussie dollar is more related to iron ore. That means any form of a risk off scenario, we start to see iron ore also potentially being sell off on the downside together with copper. So that lead to a underperformance of the Aussie against the US dollar. That means the dollar strengthening against the Aussie. Very similar to the CAD as well, because due to the relation with oil, and the Kiwi is more or less related to the movement of the Aussie, because the Kiwi itself does the major export of Kiwi is milk, okay, and they are not really have a very high, what you call it, industrialized resource intensive country. So the movement of Kiwi is more synchronized with the movement of Aussie instead. And the Swiss and the yen are traditionally safe haven currency, and the most important was the dollar weakened against the Japanese yen is due to this more we call it hawkish vibes that has been triggered off in the previous Bank of Japan meeting. But if you look at this movement over here starts to normalize, that means the K-shaped movement of the FX market starts to actually mean revert back into the mid. That means the dollar has the initial dollar outperformance against the Aussie, the Kiwi, and the CAD starts to actually normalize now towards the rest of the currency, like the euro, the Sing, the CNH, and also back towards the dollar index over here. Very similarly to the dollar Swiss and the dollar Japanese yen as well. Previously, the safe haven currency outperformed the dollar, but this dollar weakness against these two safe haven currency, the K-shape starts to ink up towards the top. That means try to cover the previous white gap that is being formed. All right. So some form also of mean reversion has really taken shape on the FX market, as I explained to you earlier, that yesterday's dramatic risk-off scenario has reached a climactic selling point or tipping point, where potentially we may start to see some form of stabilization back into the markets right now. Okay, so that covers the movement that I shared with you all that has taken shape yesterday, and now the more important bit over here is the fundamentals and the intermarket dynamics that I want to share with you all. So let me start with the intermarket dynamics of the US stock market first. All right, so this, but as we know that yesterday was a very huge volatility day event. So one thing for sure over here is that we know that volatility also can't last for a period of time. They actually oscillate. So what you could see over here is that this on top is the S&P 500, the daily chart. At the bottom is VIX. VIX is actually the implied volatility. So what you could see is yesterday move right from last Friday close all the way up to its high. So yesterday it printed a high of 66. Let me push it up. Okay, let me put it in on my Maniac. Okay, so it actually has a high of this 65.73. All right, and this high 65.73 is almost as high over here that was seen during the pandemic crisis. All right, and also almost as high. Okay, maybe let me put it in a weekly chart basis so it's easier to see. Okay, this level here, also the high reached during the great financial crisis then. So this was the blowout of Lehman Brothers. So what we could see over here, right, this movement yesterday of the VIX, right, it seems to us that market is implying some form of liquidity squeeze that's being formed in the system over here. But this liquidity squeeze, okay, this is the daily chart of VIX. Okay, this liquidity squeeze over here doesn't see an increase in the 2-year and the 10-year US Treasury yield. In fact, the 2-year and the 10-year Treasury yield is falling instead. All right, so then where the risk come from? Then we got to talk about back is that, is there any potential failure of banks that we see in 2008, or like the US regional banking crisis? The answer is also no. Why? Because there's no media report saying that there is a potential bank run that is taking shape. All right. And the next question we'll ask ourselves, are we facing a risk of a pandemic situation? No, at this moment in time, no. And potentially over here is that would there be signs of a war that is taking shape, a significant war? Yes, potentially it could be a Gaza conflict that is taking shape right now that could escalate. But that over here seems to us that at this moment in time, even though there was a report out from Iran over here, is that yes, they want to actually retaliate back to Israel, but they still want to have some form of negotiation with Israel to actually see some form of middle ground to end this ongoing Gaza conflict together with Hamas for sure. All right, so that also doesn't seem to us that we are on the brink of a World War III, given that Iran and Hamas still wants to actually go down to the negotiation table to negotiate with Israel to end this conflict. All right, so that was the news report yesterday. So what I could see over here is that this movement up over here could be related to some form of gamma gaiden or volatility sell off due to some form of quant funds that related to the option market that sell vols or sell volatility, and it causes this to actually kick off this trigger. But we know that as long as any spike in the vol, once it reach a very dramatic level, is unsustainable in the long run. I mean, it's going forward. After that, the vols got to come down. So yesterday move up was the biggest intraday squeeze up on the history of VIX since 1996. All right, it's the biggest intraday squeeze up of 181%. And this 181% and 42 points is much more greater than the previous Wormageddon 1.0 that took shape in 2nd of February to 5th of February, this big jump over here. Okay, if you go back around Wormageddon, 5th of February 2018, there was also a blowout in some VIX related trading strategy where market participants sell VIX instead. So they keep piling on the sell the VIX, hoping VIX will keep on compressing at a very low level, but instead it create that short squeeze on the VIX on the upside and create this negative risk off behavior globally as well during this point in time. So yesterday move up was rather dramatic. How do I know that? If you put in the Bollinger Band, we see that the band actually expanded way on the upside. Okay, let me put in the band. Yeah, notice this band over here expanded dramatically. So we know that at this point in time, this could be a sign of a panic selling or panic risk off scenario, which is potentially could actually be unsustainable, and it could start to subside in the coming of days going forward over here. Okay, so net overall, what we could see over here is that, and later I'll share with you all and also if you look at it, what happened over here, this was the S&P 500, right? S&P 500, and we know that the Nasdaq 100 is the main domino that causes, is the first domino that fall that causes this cascade of risk off OFF event that took shape in the last 3 or 4 weeks or so. And given yesterday's climatic push up in the VIX, which is unsustainable, that means overly too much fear in the market. Once you have too much fear in the market, it could give a bullish key reversal day to form. So let us take a look at it's still intermarket dynamics now, because now I'm trying to relate back to the weakest market, which is the Nasdaq 100, that causes this domino to fall. So if you look at the Nasdaq 100 based on the CFD pricing, because it takes the form of the futures as well. Where is it? Yeah, this is the Nasdaq 100 chart. So if you look at the Nasdaq 100 chart, what we see yesterday, very interestingly, yesterday's gap down in the Asia session is actually a key reversal day. What do I mean by that? Because of a long tail, and this long tail managed to actually got hammered out, and it closing price, it closed near the high of the day. So in Western technical analysis, they call it bullish key reversal day. Japanese candlestick, they call it bullish reversal hammer candlestick, which is also a reversal candlestick. And where this key reversal day form, bullish key reversal day form, it form right at a bunch of key technical elements which is significant. The 200-day moving average, and as well as the lower boundary of this major ascending channel in dotted green that is in place since January 2023, and as well as this cluster zone over here, which is my long-term pivotal support zone at 17,160, 16,930 level. Okay, notice this inverted V-shape up that shape this rally, and previously where the inverted V-shape formed, it formed by this previous move over here, this inverted V shape and this V shape, right? So this key reversal day that took shape yesterday confluence with a lot of elements that supports that yesterday move push down on the market is indiscriminate selling, and this indiscriminate selling over here has really lit a climatic selling point and trigger this potential bullish key reversal day, which could actually now starts to see a pause in this 3 weeks or 4 weeks of risk off scenario globally, and we potentially could now starts to see a breather and a potential short-term mean reversion risk on scenario coming back into the market, supported by this intermarket dynamics that has taken shape yesterday I share with you all right. Okay, good. So now this is more on the stock market perspective, and right now one more fundamental I share with you before today is we know that on the economic calendar today we do have a RBA meeting, all right, which is at 12:30 p.m. Singapore time. So now since we are talking about the fundamental aspect of this daily dose, let me share with you the fundamental aspect of the upcoming RBA meeting at 12:30 p.m. So what market participants expecting is no change. They will hold it for the 7th time at 4.35% in their policy cash rate over here. And also, the reason why they are saying this over here is that because in the last few we call it press conference, this is the current governor Bullock. So current governor Bullock still has this kind of hawkish vibe, saying that she's not confident that inflationary trend is decelerating as desired by RBA. All right, because if you look at the current situation here, this black line here, this line here, the blue line here is the CPI, year-on-year CPI, quarterly basis. So last month, it kind of tick up to 3.9% year-on-year. And this dotted line here is the target of RBA target of 2 to 3%. All right. So there's still some more way to go before hitting the 3 to 2% target range. The upper limit is the 3%. So if you look at the 3% upper limit. So based on the past few public remarks by the RBA governor, she's still not confident that the move of the inflation trend is heading towards the threshold of the 3%. So very likely the market is expecting her to hold rates as 4.35%. And what will determine the next will be the release of the inflation outlook that's going to accompany at the rate decision later on at 12:30 p.m. Singapore time. And previous May, RBA surprisingly upgraded the inflationary forecast in Aussie land. All right, so let's see what's the take on that. That could have impact the market. But based on market pricing right now, on the futures market, because it's something like a CME Fed Watch 2. Now it's the RBA rate tracker. So this rate tracker can be, you just Google ASX RBA rate tracker, compiled by the Australia Stock Exchange over here. So this RBA rate tracker is not almost as live as the CME Fed Watch 2. It will be delayed by 1 day. So this data is as of the 5th of, okay, what's this on the close it? Okay, where was it? Because there was the date. Okay, let me see where is the date, because this data is not a live data, because it will show you where is the date as of now. Yeah, as of market close 5th of August. So that was yesterday. So every of this data will be delayed 1 day delayed, not as live as the CME Fed Watch 2. All right. So if you look at yesterday's data, this is the 30-day interbank cash rate futures implied yield curve. So we know that the markets right now is 4.35%. All right, so take this as a proxy of the official cash rate, the target rate controlled by RBA, and market will actually have place bet whether there will be dovish cutting or hiking. All right, so if you look down the curve over here, August contract, September contract, October contract, November contract. So if you look at the November contract over here, it implies a yield of 4.06%. So market is only looking for at least somewhere about a 25 basis point cut or 20 basis point cut to bring it down to 4.06%, because now the current rate is at 4.35%. So market is only expecting the RBA to act in November meeting, way after the Federal Reserve meeting in September, which Powell has already signaled more or less in September. Now it's only a deciding whether it will be a 50 basis point cut or 25 basis point cut, all depending on how the market moves ahead in the next 3 or 4 weeks before September, the meeting. But what we know for sure is that RBA is not as dovish as the Fed as being portrayed by the timing of the interest rate cut based on this 30-day interbank cash rate futures implied yield curve. So that potentially could also support the Aussie dollar to shape that potential minor mean reversion rebound against the US dollar, because in the last few weeks it has been selling off against the US dollar in line with the globalized risk off scenario. So right now we know that the risk off scenario may stabilize, but just now I shared with you all the dramatic push up in the VIX, and that could lead to a potential bullish key reversal day in the weakest pack of them all, which is the Nasdaq 100. And right now we have a key event taking shape, which is RBA, and this RBA meeting over here, very likely the governor will actually still stick to her same script, kind of a hawkish hold, and potentially no change in their tonality, and in line with what is being implied on the interbank cash rate futures market, saying that potentially only the RBA may only cut in November meeting by 20 or 25 basis point, way after the US Federal Reserve. So that also could be potentially supportive of the Aussie dollar, at least from a short-term to mid perspective. Okay. Okay, so this is the fundamental we share with you. Now, with that, let us now jump straight into the short-term intraday technical outlook. All right, starting from the FX market. All right, so from the FX market right now, let me expand my screen so that you guys could have take a better look at the market. So yes, so we know that over here, this will be the euro dollar. Okay, so we know that yesterday euro dollar we do have a bullish bias to see a short-term intraday push up, and it push up right exactly at our set resistance level that we highlighted, 1.099/1.10 level. And very interestingly, after this push up over here, the hourly RSI has now shaped a bearish divergence, so also indicating that momentum now starts to turn weak on the euro dollar, and potentially we may now start to see a slight coming downwards potentially on the intraday technical basis. And what we could see over here is that now the price action is attempting to reintegrate back into this gray line here. So what is this gray line? So this gray line is in fact this line here. Let me expand it again. Okay, so this gray line over here is the, we call it the medium term symmetrical triangle range resistance that is in place since 19th of July 2023. Previously this push up it kept it, and right now it kept it as well. Okay, because yes, intraday you see a push up, but from a daily candle basis, the daily candle didn't close above the gray line over here. All right, so net is actually still at the resistance level, didn't get a proper actual bullish breakout, because since this is a daily chart, you need to have a daily breakout to actually more or less reinforce this medium term bullish breakout of the symmetrical triangle. But it didn't have yesterday. It's only a intraday break. Then after the intraday break, it hit our resistance and fall back into the symmetrical triangle range resistance again. So another sign of short-term weakness that could actually be taking shape right now as we are speaking on a intraday technical analysis perspective. So with this two key negative elements that has taken shape on the euro dollar, so for today on an intraday basis, we will flip to a intraday bearish bias from a technical analysis perspective, for sure using 1.0990, 1.010 as my short-term pivotal resistance level. First near-term support level to watch in this short-term intraday bearish bias basis on the euro dollar will be at 1.0895. A breakdown below it exposes 1.0870, which is the former minor swing high of 25th of June, and 29th of June now turns into a pullback support level. Only a squeeze up with an hourly close above 1.099, 1.10 short-term pivotal resistance will invalidate today's intraday bearish bias on the euro dollar to see the continuation of the rebound to expose the next resistance level at 1.1060 / 1.1080. Above it potentially sees the 1.236 Fibo extension at 1.1130 level, and this 1.1130 level, if you go to the daily time frame, it also corresponds to the swing high area, the medium term swing high area of 27th of December 2023. Okay, so that's for the euro dollar. And flipping on next will be the sterling dollar. So sterling dollar, yesterday we also do have a bullish bias holding above this 1.2735 pivotal support level, but it didn't break above the first resistance that we highlighted yesterday, and it traded sideways way below the 50-day moving average. And right now it seems to us that it's forming this minor descending channel that is oscillating within it on a intraday basis since 17th of July 2024 high. So given this, we call it a lack of bullish momentum to push it higher yesterday, and it tried to start to trade sideways, I'll be using 1.2830, very close to the upper limit of this symmetrical, this upper limit of the upper boundary of this minor descending channel, to be my short-term pivotal resistance for today, 1.2830. So 1.2830 will be my short-term pivotal resistance. Flip to a short-term intraday bearish bias on the sterling dollar within a sideways range configuration first. 1.2735 will be the first support level to watch, followed by 1.27 figure level, the bottom of the range, right, which is this minor swing high area of 25th of June, and 2nd of July turns into a pullback support as well. Only a breakdown below 1.270 figure level may see further weakness to expose the next near-term support at 1.2660, which is correspond also to the 200-day moving average acting as a support and the lower limit of this minor descending channel. Only an hourly close back above 1.2830 will then reinstate the bullish bias on the sterling dollar that invalidate today's bearish bias for sure, to see a potential squeeze up towards the next near-term resistance at 1.2890, which confluence with the 20-day moving average acting as a resistance as well. Above it may see the minor swing high area of 22nd of July and 24th of July acting as a next near-term resistance at 2940. And if you do the Fibo retracement of this ongoing entire down move over here, that also synchronized very closely to slightly below the 61 point, in between the 61.8% Fibo retracement and the 76.4% Fibo retracement. Okay, so that's for the sterling dollar. So now with that, let us now shift our focus to the Asia Pacific currency against the dollar over here. Okay, so let us start with the Aussie dollar first. So Aussie dollar, if you recall yesterday, we do have a bearish bias hitting back below the 64 figure level, which is hit exactly. And where it hit exactly right now, it managed to stage also a key reversal point. Okay, right exactly as the key reversal day on the Nasdaq 100 as well. Notice how synchronized this market are. Firstly, the Nasdaq 100 is the weakest major stock indices that kickstart this global risk-off event. And this global risk-off event also lead to the Aussie dollar sell-off. And just now I share with you all the rolling performance chart of the Aussie dollar, the previous K-shape for those who follow my daily dose. The Aussie dollar is the weakest against the dollar, against other major currency. Notice how the very interesting intermarket relationship. And once the Nasdaq 100 formed that potential bullish key reversal day on just now the daily chart I shared with you all, very similar bullish key reversal day is being formed on the Aussie dollar as well by this bullish hammer. And this hammer is not being formed in the middle of nowhere. It's being formed at a key technical element level, which is the lower boundary of this symmetrical, we call it this lower boundary of this ascending trend line support that I drew from the low of October 2023. So that is a medium-term ascending trend line support Also confluence with the medium-term swing low of 10th of November at last year and 19th of April 2024 at 63.60. It bounces right exactly at this level over here. So with this positive key element that is being taken shape and the intermarket dynamics that is have with the Nasdaq 100, we will flip to a bullish bias on the Aussie dollar for today after the fact that it has really hit our support yesterday, and using a tighten key short-term pivotal support for today because the price has really risen by a fair bit, which is yesterday's European session low, this higher low that's being formed at 63.35, and this 63.35, if we do the Fibo retracement over here, it also correspond to the 50% Fibo retracement. Okay, my apologies, it's a typo error. Okay, let me rewrite it, 64.35. So using a tighten short-term pivotal support for today, 64.35 level, all right. Any potential pullback, as long as didn't break below 64.35, we'll flip to a short-term intraday bullish bias on the Aussie dollar. Near-term resistance to watch for today ahead of RBA will be at 65.60/65.80. This bunch of we call it four minor swing high area and the 200-day moving average acting as a resistance. Above it exposes 6610/6630, which confluence with the 20-day and the 50-day moving average acting as a resistance. And if we do the entire decline that has taken shape from 11 August all the way up to yesterday's Asia session low, it also corresponds to the 61.8 Fibo retracement level as well, right? That's the golden ratio. Only an hourly close below 64.35, that means price action comes down below the hourly close below 64.35, will invalidate today's intraday bullish bias to see a retest again at the medium-term pivotal support level. That means a 64 level, then followed by the 63.60/63.50 level, which was yesterday's swing low, and also that lower boundary of that medium-term ascending trendline support that I shared with you all on the daily chart. So that's for the Aussie dollar. And what's interesting over here is that the dollar yen. So dollar yen yesterday also came down and hit the 144.60 level. That's our short-term support level that we highlighted as well. The hourly RSI, the daily RSI also hit a extreme oversold level as well, what we could see. So given this extreme oversold level, potentially there could be some form of a mean reversion rebound taking shape as well. And given the fact that the dollar yen also was facing that indiscriminating selling in line with that global risk-off scenario where we start to see a very dramatic push-up in the yen strength. So what you could see over here is that, let me open up the RSI. This is the hourly chart of the dollar yen. Okay, if you look at the, oops, sorry, let me call up the indicator again because I'll share something with you on the RSI, which I accidentally deleted. Okay, give me a minute. Okay, RSI. Okay, good, the RSI is up. Okay, so what I could see over here is that yesterday it came down over here, formed similar low at the support level that we that we highlighted yesterday at 141.60, 141.40. That was the support where we have a bearish bias yesterday, hit the support level, and before it bounces off, it actually bounces right off the support level, which indeed is a support level, and the RSI shaped a bullish divergence, okay, further supporting this potential ongoing mean reversion rebound signal that is potentially taking shape on the dollar yen, supported by that intermarket dynamics that I shared with you all. So given the fact that this is still indeed a key support level, so I don't want to type my short-term pivotal support so tight at a 143.60 level, given the way it moves in the last few days. So this will be my first support level for any pullback. So as long as a pullback didn't surpass 141.60/40, we'll flip to an intraday bullish bias on the dollar yen for this potential mean reversion rebound or a stabilization in the last 3 to 4 weeks of risk-off behavior that has been too extreme or far-fetched. First resistance level to watch on the near term will be at 14850 level over here. Above 14850 level sees 151 figure, 15170, which correspond to the minor swing high of 1st of August and 2nd August, and the 200-day moving average acting as a resistance. And if we do that entire sell off from the high of 3rd of July all the way down to yesterday's Asia session low over here, this level also correspond to the 50% Fibo retracement as well. All right. So, however, only if price action starts to break down below 14140 level, then today's intraday bullish buyers will be invalidated to see a further sell off on the dollar yen or a impulsive down move sequence to continue to expose the next support level at 14025, followed by 139 figures slash 13810, which is the one-time Fibo extension level over here, and also this 13910, 13930 level is related to way back over here, this congestion, this minor swing low of 18th of July and 28th of July last year. Okay, these two swing low over here. Okay, so that sum up the intraday technical outlook on the major FX pair. So now let us shift our focus now to the major stock indices over here, starting with the Asia Pacific stock index first, which is the Hong Kong 33. All right, so the Hong Kong 33 over here, let's see what's cooking over here. So what's interesting over here, this Hong Kong 33 now, yesterday we do have a bearish bias after it break below the neutrality range, with the neutral first, hit the first support level after the neutrality range has been broken down at 16,460 level. So 16,460 level over here, we start to see some form of ongoing positiveness in the hourly RSI, as the hourly RSI continue to shape that higher low after yesterday's bullish divergence. So with that, I'll be using yesterday's low over here that is being made as my short-term pivotal support now on the Hong Kong 33, or i.e. the Hang Seng Index. Okay, so this will be my short-term pivot level. Okay. Okay, this level here, this one will be the first resistance level to watch, no longer a pivotal resistance. Okay, so 16,460 short-term pivotal support level, flip to a intraday bullish bias on the Hong Kong 33 or the Hang Seng Index for that potential mean reversion rebound scenario taking shape. First resistance level to watch 16,970, followed by 17,185 on the intraday basis, and above it may expose 17,410, 17,517, which is the 20-day moving average acting as a resistance level as well. But however, if price action instead of bouncing up and starts to go down and break below for 16,460, then today's intraday bullish bias will be invalidated to see the continuation of the down move on the Hong Kong 33 to expose the next support zone of 16,130, 15,960 level, which is the one-time Fibo extension level as well, taken from this ongoing decline that is in place since 17th of May, and also graphically this minor swing low area of 16th of February and 19th of April 2024 this year. Okay, that confluencing with the one-time Fibo extension level. Okay, so that's for the Hong Kong 33. Now let us move on to the Japan 225. So interesting, I want to share with Japan 225 is before we go to the intraday chart, let's look at the Nikkei 225 weekly chart over here. So what do I mean by also forming a potential key reversal as well? So this is a weekly chart. So yesterday on the weekly chart, right, when Nikkei closed at 2:30 p.m. Singapore time, this is the cash market, it formed a long black candle, and this long black candle from a 4-week rolling performance, it actually declined to a low of negative 26%. And where it declined over here, it declined exactly right at the lower boundary of this major ascending channel that is in place since the COVID low of 19th of March 2022, and as well as this former major swing high area of 30,460 now turns to a pullback support, we also correspond right exactly at the major ascending channel lower boundary. So this is something like a long-term pivotal support level, and this long-term pivotal support level managed to hold yesterday dramatic collapse, which is at 12% on a daily basis. Daily basis, it fall down by 12%. So you look at the daily day chart. Notice there's this long black candle, dramatic gap down. Okay, so this particular gap down on the Nikkei 225, you look at the weekly chart, it has really formed a bullish in the progress key reversal candle as well. Why? Because this is a weekly chart. We only need to confirm it on Friday, by Friday close. But it seems to us that potential key bullish reversal price action is also taking shape as well on the Nikkei 225, which is also the second weakest domino that causes the cascading global risk off scenario that took shape last week or so. All right, so now with two elements, with more and more elements that start to say that yesterday's sell off or yesterday's risk off scenario is indiscriminating. That means it's more like an extreme irrational behavior, and the current price action based on the technical perspective, fundamental and intermarket perspective, it seems to us that we are now ripe for some form of stabilization after yesterday's dramatic risk off scenario. All right, this is the Nikkei 225, this on the weekly chart. Okay, so now flipping back to the intraday perspective on the Japan 225, this is our from our trading platform. We start to see this recovery already taking shape over here. So with that, because it's already rebound by a fair bit as we are speaking right now, I'll be using a rather tightened key short-term pivotal support for the Nikkei 225 or the Japan 225 on the intraday basis at this 32,710 level based on our platform, the Japan 225, 32,710 short-term pivotal support level, flip to a intraday bullish bias, because yesterday it came down, hit our support level as well at 31,400, okay, before it shaped that bounce. Okay, very close to that 31,500 on the cash index that I shared with you a while ago. All right, so this level here came down, hit our support level already and shaped that bounce. So this is indeed a key support level as well. So but we have a tightened one because price action has really move up by a fair bit. So as long as any pullback didn't surpass below 32,710, flip to a bullish intraday bias on the Japan 225 for this ongoing mean reversion rebound scenario to play out. Next near-term resistance to watch 35,750, followed by 36,885 / 37,480 on a intraday basis, which will correspond to the 200-day moving average as well, and the former minor swing low of 25th of July. Okay. However, if price action starts to come down, break down, and break below 32,710, with hourly close below it, then this intraday bullish bias scenario will be negated to see a retest of that 31,400, followed by the long-term pivotal support on the Japan 225 chart at 30,170 level. Right, so this is for the Japan 225. Now moving on, next will be the German 30. So for the German 30, if you recall, yesterday was neutral level, and it hit the lower neutral limit and hit the support level right exactly at 70,030 before it shaped that bounce. And right now, in the Asia session, it managed to reintegrate back above the 200-day moving average over here. So with that, I will have a first support level at 17,300 level. As long as during the European session, any pullback it didn't surpass below 17,030 level, we also flip to a intraday bullish bias on the German 30 index for the mean reversion rebound scenario to take shape. Next, near-term resistance level to watch on the intraday basis, 17,730 followed by 17,960. But however, if price action starts to see a breakdown below 17,030 with an hourly close below it, then this intraday bullish bias will be invalidated to see this potential continuation of the impulsive down move to expose the next near-term support level at 16,780, 16,460 level. All right, so that's for the German 30. Very quickly will be the US Wall Street 30, one of the major US stock indices. So the US Wall Street 30 also came down and hit our support yesterday. So yesterday we do have a bearish bias. It also hit the bearish support level at around 38,700. So I will use yesterday's swing low here at 38,375. Okay, which is also correspond to the swing low area of 5th of June and 17th of July, slightly below the 200-day moving average. So as long as this 38,375 short-term pivotal support holds for today, we will flip to a intraday bullish bias on the US Wall Street 30 for that potential mean reversion rebound to play out as well. Near-term resistance to watch will be at 39,190, 39,480, followed by 39,845, which also correspond to the minor swing low area of 25th of June and 24th of June, former minor swing low area of 25th of June. So if we do the Fibo retracement of that previous sell-off, okay, the dramatic sell-off, the last leg of the dramatic sell-off, it also correspond to the 50%, okay, close to the 50% Fibo retracement. All right. So, but however, if price action starts to break down instead and have an hourly close below 38,375, then this intraday bullish bias will be invalidated to see the continuation of the impulsive down move to expose the next near-term support level at 30,080, which is the 200-day moving average. Below it sees 37,760, followed by 37,380 level, which is the minor swing low of 19th of April, and also confluencing with the 1.236 Fibo extension, all right, from the high of 1st of August. Okay, so that's the US Wall Street 30, NASDAQ 100. So technical analysis on NASDAQ 100 also hit our support level yesterday. So yesterday we recall we do have a bearish bias. Support level hit 17,400, 17,310 before shaping that bounce. Okay, and it also shaped a bullish divergence as well. Okay, higher low on the RSI, but similar low on the price action on the NASDAQ 100. And also that potential key reversal candle on the daily chart that I shared with you also, and also price action now has already reintegrate back above the 200-day moving average after yesterday dramatic sell-off, okay, over here. So using that 200-day moving average, which is also the higher low that's being formed during yesterday's closure of the US session. So this will be my tighter short-term pivotal support for today, 17,790. So as long as any pullback didn't break below 17,790, we will flip to a intraday bullish bias on the NASDAQ 100. First resistance zone you got to surpass will be the gap resistance that was formed yesterday, the gap down at 18,400, above 18,400. Okay, so let me remove this, 18,400. The gap resistance above 18,400 will more or less reinforce that mean reversion rebound scenario. Next resistance to watch 18,680, followed by 19,230 level. All right, then but however, if price action starts to come down and break below 17,790, that will actually invalidate the intraday or negate the intraday bullish bias to see a retest of yesterday's swing low at 17,400/17,310. Only a breakdown below 17,310 will ignite another impulsive down move on the NASDAQ 100 to expose the next resistance level in the near term at 17,160, 16,930, followed by 16,600 level, which is the 1.236 Fibo extension level and 1.382 Fibo extension level. And if you go back over here, is also the graphical area of this zone as well here, the congestion area, okay? The upper limit and the lower limit of this congestion area from 11th of Jan to 18th of Jan 2024. Okay, so that sum up the intraday technical outlook on the major stock indices. Now with that, let us now focus on the key commodities, starting with gold XAU/USD. So for gold XAU/USD, yesterday was a wild move. We do have the 2,400 level as a short-term pivotal support. It came down, hit the 50-day moving average and bounce back up again above 2,400 level. So it seems to us that gold itself also got impacted by yesterday's wild move across the board as well. So it seems to us that if you look at yesterday's move and taking into account of the move since its fresh all-time high, the current fresh all-time high of 17th of July, it seems to us that since the fresh all-time high of 17th July is now being trapped inside this minor symmetrical triangle range configuration depicted in purple line, the upper boundary over here, and this is the lower boundary. All right, so now it seems to us that it's in the middle of the range of these two range over here. So for sure, I cannot have a very tight pivotal support level either on the upside or on the downside over here. So I will use the lower limit over here. Let's say if price action starts to come down and it didn't break below 2,377, so that will be my short-term pivotal support level for today on gold XAU/USD. Resistance level to watch will be at 2,457, 2,470, which is the upper limit. The zone is a resistance zone, and also the upper limit of the symmetrical triangle range resistance. That's the two key levels to watch for today on gold. But however, if price action starts to go down and instead of bouncing off from 377 and it starts to break down below it, there potentially gold itself faces risk of further short-term weakness because there's a bearish breakdown. And in short term, the next two support level to watch will be at 2,353 followed by 2,336, which is the former minor swing high area on 28th of June and 1st of July. Okay, so that's for gold XAU/USD. Now, moving on will be the West Texas crude oil. So the West Texas crude oil on the daily chart managed to also form that potential daily key reversal candlestick right at the 73.15, 71.35 medium term range resistance that we highlighted yesterday as well, which is the symmetrical triangle lower boundary that is in place since 20th of March 2023. So very interestingly, lots of key reversal candle or price action that's being formed for those previously start to see indiscriminated risk of global synchronized price action that has taken shape in the 2 or 3 days ago. And yesterday was the most climatic one that created this key reversal bullish price action. So with this key reversal bullish price action on West Texas oil on the daily chart, we'll still maintain that potential intraday bullish mean reversion bias scenario that we have yesterday. So yesterday we do have 73.15 as a short-term pivotal support level, kind of whipsaw. So we use yesterday minus swing low as access. So 73.15/72.24 level, short-term pivotal support level, still maintain a bullish bias on the West Texas crude oil on the intraday basis for this mean reversion rebound signal to play out. First resistance level to watch 74.46, above it potentially exposes 77.22. Next term, the next near-term resistance level. However, if price action starts to tumble down again below 72.24, then this intraday bullish bias will be in jeopardy to expose the support level of 71.35 and potentially even 70.40 level on the short-term basis. So what 70.40 level? 70.40 level is this minor swing low area of 3rd of January and 8th of January, all right, over here. Okay, so with that, that sum up a very interesting take on today's daily dose of market insights, because very important price action has started to form given yesterday dramatic price action. So before we go for today's daily dose, let's take a look at the economic calendar again that could actually impact price action as well in terms of the event. So we know that 12:30 p.m. About half an hour from now, we do have the RBA interest rate decision, which I've covered much ground earlier on. And after RBA, what other data to look out for today? So in the US, European session will be rather quiet, except for retail sales data in Eurozone that's out at 5 p.m. Singapore time for the month of June. And in the US session will be rather quiet as well. All right, and right earlier in the morning, for those who are interested in the Kiwi dollar pair, means the Kiwi dollar, 6:45 a.m. Singapore time, we have New Zealand job data out, employment change, something like a non-farm payroll data, and as well as the unemployment rate, both out at 6:45 a.m. Singapore time. And that should sum up today's daily dose of market insights. This is Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.